In the past month, I've made some big changes to my stock portfolio as I try to fix the greedy mistakes of my past. Today, I will reveal why my portfolio is greedy and how I plan to fix it. But first, my stocks are down 43% in 4 years. Why am I still invested? Well, despite the mainstream narrative of buying a diversified index fund and investing regularly, I invest in individual stocks as I believe a dedicated investor can learn how to find companies that are simply better than the index average. However, this is easier than it sounds, and I believe it takes many years to acquire this skill to buy these above average stocks at a fair price. Remember, every investor has a unique situation with different goals, risk tolerances, and investment timelines. So you should understand that I can afford to make mistakes now at 24 years old, as I could always buy an index fund at 30 and still be at a great position for retirement. That's not all. Stocks and shares are not the only string to my bow. I'm also building a business and a career. So by the time I'm earning a significant income, the journey might just teach me the lessons on how to invest successfully in stocks, or it might just give me the wisdom to buy an index fund and dollar cost average at 30 years old. Yet I'm still so far from buying an index fund, and it's made my portfolio greedy. So why is that? In the past, I thought that by buying more of one good stock that it could drastically improve my long-term returns. It was easier to overlook the greater risk and neglect how much of a negative impact it could have. Risk management was certainly a big factor in my underperformance, but my real mistake is best explained with a story. I want you to imagine a company that manufactures lifts for restaurants with multiple floors. Let's call this stock Up and Up. And let's say the kitchens use Up and Up's lift to quickly get food to their waiters in different dining areas. The lift quality is fantastic, and the restaurant is happy with its reliabilities, and the customers get their hot food on time. In fact, Up and Up's lift is so well made that with proper use it can last for decades without maintenance. Up and Up's sales rocket. Every restaurant in town is happy and has one of these lifts. Over time, Up and Up starts to run out of restaurants to sell their lifts to, and due to the superior build quality, the restaurants don't need maintenance on their lifts. Unfortunately, Up and Up went bust. The lesson of the story is that a business can have a great product or customer experience, but that doesn't make it a good investment. The business model needs to be sustainable, and in my experience, I bought too much of seemingly a good company that had a weaker business model. And this is in part a secret of how I plan to fix my stock portfolio. So how does understanding Up and Up's failure help me fix my stock portfolio? If we had looked at Up and Up's financials as the business started to slow down, we might have a graph like this, with sales growing really fast at first, but slowing down as the demand fell in the restaurants. To avoid buying into a company like Up and Up, which looked like a great investment at first, I will focus on the predictability of its income and check if it's consistently growing free cash flow year over year. Sure, I might miss out on the exciting high growth opportunities, but I feel more confident knowing the company will likely be around in the next 20 years. But you might have been a shrewd investor, noticing the falling quality of Up and Up's financials, and you sold Up and Up just in time. Then, with the money, you bought a cheaply trading lift company, Down Lifts. Down Lifts is trading at a 50% discount, and it looks like a bargain. As a UK investor, you probably love a bargain, and this cheap stock is a must buy. However, Down Lifts actually had problems selling its stock to restaurants and had to go into administration before Up and Up went bust. This meant that even though you spotted the red flags in Up and Up, you still lost your money. I think that the story of a shrewd investor highlights the impact of diversification based on quality. Things are usually cheap for a good reason. So rather than try to identify the next bargain opportunity, why not focus on buying a quality stock at a fair price? More importantly, if an investor had compared Up and Up and Down Lifts to the index average, they likely would have seen the red flags in the quality of the business models. In this example, Down Lifts had a lower operating margin than the index average, but Up and Up did not. so we'd award a point to Up and Up. On the other hand, Up and Up and Downlifts both had a lower cash conversion compared to that of the index average. In this case, neither company would get a point. Eventually, we would be able to rank the two companies by a score based on KPIs. Then we could decide how durable the business model is and diversify appropriately. In fact, by adopting this approach and diversifying by the quality of a business model, I was able to avoid the short-term hype of this stock and subsequent correction. So before I reveal what happened to this one stock, I'd like to let you know that you can view all of my holdings for free. To find out more, click the link in the description down below. This stock was the second largest holding in my portfolio. It's a market leader and a really well run company. However, to my surprise, when I checked the quality score of this stock, it ranked the lowest of all my holdings. I discovered that while it can compete on price due to economies of scale, it can't easily raise prices or launch a differing product to make more money. So I decided to sell half of my position in Ashtead Group, 35 shares, because I have faith in the company but understand it has a more fragile business model compared to the other two stocks that I bought. I bought shares of this first stock because I think investors are wrong. It's trading at a slight discount to the market average, but has a far greater quality. Investors fear that its main profit driver will erode to competition over time, but I can't imagine a world without it. Even if the business model failed overnight, it's sitting on a war chest of cash and can pivot any direction that it chooses. With this in mind, I've bought 13 shares of Alphabet, bringing it to 14.3% of my portfolio. The other stock that I bought might be controversial because on paper it's trading at an enormous price to premium to its profits. Some investors will assume that this business will fail with the UK, but that's because they don't understand the data and analytical side of the business and the powerhouse that it has become. I've bought 10 shares of the London Stock Exchange Group, bringing this to 9.4% of my portfolio. Given the big changes this month, you might want to stay up to date on my portfolio. Click here to learn about how you can view my entire stock portfolio for free.